Folks, when some of the best businesses and the best performing stocks pull back, traders have a tendency to freak out and dump shares like crazy. But that's usually a major mistake. And today's lesson will change your perspective. Get the lowdown now, click the button below. Find out how to use your newfound knowledge to score the next big winner while others are panicking. Folks, there's no denying it. Most traders fear down days in the markets, but I don't. In fact, I'm a huge fan of down days. Why? Because they've delivered some of my biggest gains. Today, I'll tell you why down days can hold great opportunities for you. And we'll take a look at a perfect example of how you can start using them to your advantage right now. All right, folks, I'm going to talk about pullbacks, how to trade pullbacks. And this is really important. I want to show you something really cool, and I think you're going to enjoy this. Now, a lot of traders, there's a tendency to believe that trading must be complicated. If it's not complicated, it doesn't work. It's not effective. It's not going to work for the long term. I'm going to tell you something. The simplest systems, the simplest methods tend to work over time. I gave this example many times, and I'll do it again. Imagine a tight-fitting suit. A custom suit, you paid thousands of dollars. If you gain 5 pounds or you lose 5 pounds, it's not going to fit you. If you have a pair of sweatpants that you buy for $15 at Kmart, if you gain 5 pounds or lose 5 pounds, they'll fit you fine. I'm sure you have sweatpants in your closet that are 20 years old. I do, because they just fit like a couch. It's like sitting in an old couch. It fits. So they're not going to look as good as a fine fitted $2,000 suit, but they'll fit you. And that's the key. You want a system that'll fit different market variations, different market behaviors. You don't want a tight system that'll only work really, really great when the market is breaking out or making a 52-week high. You want a system that'll work in a wide variety of conditions. And that's why I always use that as an example of a sweatpants versus a tight-fitting suit. So here we have this is just a simple exponential 20-day moving average. And this is a pullback system. Now, this pullback system that I'm going to show you, it's been around for about 40 years, maybe more. So it's not new. It was first actually applied to the commodity markets and futures markets, then to the currency markets, and then later when stocks became volatile, you were able to apply this to the stock market. So the trick to this system is to find an asset that's trading above the 20-day exponential moving average. And the 20-day exponential moving average is available on every technical analysis program that exists. It's probably one of the oldest indicators. It's been around since the 60s. If you go to barchart.com, it's free. There's no cost. Stockcharts.com. Any charting software will have an exponential moving average. The only thing you'll need to do is set it to 20 days, like I did right here. See, moving average, exponential, 20 days. It's that simple. You just go to study. You select the exponential moving average right here, right there, I keep looking at envelope, exponential, not envelope, exponential right here. You click on it, and then you put the amount of days, and you're good to go. That's how simple it is. I just made the mustard-colored line a little fatter. That's about it, a little wider. All right, so you find an asset that's continuously trading strongly. You want an asset, and it doesn't matter if it's a stock, commodity, bond, it doesn't matter what it is. Here you're looking at an asset that's breaking out, that's making highs. It doesn't have to be making highs, but I would start with an asset that's making a 52-week high, a 90-day high, an all-time high. Usually when an asset is doing that, it's typically trading above the 20-day exponential moving average. And then what you do is you start watching it. And you start watching for the asset to pull back to the 20-day moving average, exponential moving average. And if it touches the 20-day moving average, you buy on the next open. So you would buy right here, and you would be able to ride this wave right here. You see it touches the 20-day moving average, you buy in the next open, and you ride this wave. See here, it touches the 20-day moving average, you buy here, and you ride this wave. So it's a real simple system, and it works really well if the stock is a monstrous trending stock. It has to be. The key is the asset has to be trending. So that's why I say always find stocks or commodities or currencies or Forex that's trading at a 52-week high, 90-day high, all-time high. That way you're ensured that it's breaking out and it has more upside left. So again, now, why is this a cool system? I'll explain why. Typically, when markets pull back, when they're trading against the trend, you'll see a shakeout. You'll see a lot of amateurs pull out of the market. And what that does is it leaves the smart money in the stock, and the smart money continues to accumulate and increase their exposure. So usually when you see a pullback like that, one, options are going to be undervalued. Two, so you're going to be able to buy call options really cheap when the market takes out a 20-day high. B, it'll shake out a lot of traders out of the market. I could assure you a lot of stops get hit right here, because what traders do is they buy above the 20-day exponential moving average, and then they'll put their stop loss right at the 20-day exponential moving average, like right here or right here. And what you're doing is you're buying after all the traders just got stopped out. So you're getting in right after the majority of traders who are just trying to time this stock are just getting shaken out. And that's probably the best time and the lowest risk entry opportunity you will find. And there's several. This one uses the 20-day moving average. Some of my trades use a 10-day low for a pullback. Some of them use a 4-day low. In other words, we need to see 4 continuous bottom days. But I like this one because it's really simple and it just uses one indicator, the 20-day exponential moving average. Now, I know a lot of traders are going to ask me, why do I use the exponential moving average instead of the regular moving average? Well, the truth of the matter is, if I use a 50-day moving average or if I use a 200-day moving average, I'm going to use a regular moving average because that's a sentiment indicator. That's going to tell me if markets are bullish or bearish, or if accumulation is coming in or not. That's a barometer indicator. An exponential moving average, I'm actually going to use to time the market. And a 20-day exponential moving average is sensitive enough to do that. A 50-day moving average, whether it's exponential or regular, is just not. It's not sensitive enough. It's taking in too much data. 50 trading days is a lot of data. 200-day moving average, too much data. Those indicators are better used as market barometers. So if it's above the 50-day moving average and above the 200-day moving average, that means the stock or the asset is bullish. If it's still below the 200-day moving average or below the 50-day moving average, it means it's lower. It's bearish. So above bullish, below bearish. That's a very simple market barometer. It's like cold or hot. But in this case, we're not using this as a barometer. We're using it as an entry and exit. Exponential moving average puts more weight towards the latter half of the equation. So it puts more weight in the last 5 days than the first 5 days, so it's more reactive. And you want an indicator that's more reactive when you're using it for entry and exit. So I won't go beyond the 20-day exponential moving average for entry and exit. That's kind of like my stop point there. 10 is good, 15 is good, 20 is good. So again, I like to use this for pullbacks. It's an exponential 20-day moving average, and it combines really well with 52-week highs, all-time highs, 90-day highs. And you would wait for an asset to make those highs. You would start following it, and you would put an alert right at the 20-day line. And instead of entering there, you would just wait for it to trade below it, stop a bunch of traders out, and you would get in the next morning on the open. I hope that helps. And again, don't be scared of pullbacks. Pullbacks are your friends. Why? Because it shakes out the weak hands and it leaves the strong hands in the market. And that's where you want to position yourself with the strong hands, the institutional traders, not retail traders that are getting stopped out every 5 minutes. Hope that helps. Now, do you see why I love down days? Want to learn more about how to take advantage of them? I'm holding a special training class and you don't want to miss it. I'm going to give you power to spot these rare explosive stock events that most traders never catch. With this strategy, you'll see wins like 339% in 4 days, not 4 years, not 4 months, not 4 weeks, 4 days. And I'll show you exactly how we did it. The training kicks off shortly, so click below to register now because the next down day is right around the corner. And I want to see you in on those gains. Click the button below and attend this free training. I'll see you there.